Because Reliance was up by close almost 4% yesterday, and it's starting slow but starting higher. So that's important for the market and what it does for the market. So if it starts to continue with its move from yesterday, that does a lot. But even with just a 0.5% move on Reliance, the Nifty is up 86. So there is support from elsewhere, which is showing up at this point in time. So we got about 78, 80 odd points on the index right now, and we are just kind of starting the day at this point in time. We'll come back to more stocks and what's happening all around in a bit from now. Our market master of the day is ready with us. Manishi Raychaudhuri is Asian Equity Strategist, Equity Cash, Asia Pacific at BNP Paribas. Manishi, great to have you with us here. Thank you very much for your time. Your first thoughts, Manishi. We are seeing a pullback. The question is, how you would go into the market will vary depending on what you make of what we've seen recently. Did we see just a pullback and a broader up move, or has the trend itself changed? Your thoughts?
In the near term, we have to be cautious about equity markets, not just in India, but across emerging markets, across Asia, for the simple reason that the money supply to financial assets, to risk assets in particular, that is gradually being turned off. The Fed has talked about curtailing inflation at any cost. BNP Paribas economists believe that there will be 4 rate hikes of 50 basis points each. One of them have already happened, so 3 more till about September. And possibly more importantly, there will be quantitative tightening, QT, commencing from June. The upcoming episode of QT would be more severe, more stringent than what we have seen during 2017 to 2019. If I put all this together, then this flurry of FII outflows that we have seen from Asia and particularly from India would likely continue for some more time. So we have to sort of tighten our belts. We have to be cautious. We have to be defensive during the summer. India, to some extent, is shielded from the domestic flows, but even there, the rise in bond yields is actually negating some of the reasons why the domestic investors were investing in equities in the first place. So, I think this is the time to be defensive. Some of the themes that we're positive on, there are some stocks, some sectors in India which are beneficiaries of currency depreciation, like IT services. They would continue to do well. In times of yields going up, the net interest margins of the banks and other financials, they tend to rise. Therefore, that should also be a sector worth watching. So there are some of these pockets which are still investable. And fortunately, India has a very large array of stocks which are still attractive. Yeah, so I think investors would have to be careful. They have to be selective in the near term.
Manishi, good morning. Financials and IT put together would be well over 50% of the index, right? So in that sense, do you think that the index could have actually bottomed out and could actually do well from here?
I think it's too early to kind of take that call right now because if one looks at valuations, I mean, Nifty is trading at about 18 to 18.5 times 1 year forward, which is still about 15 to 20% higher than the long-term average, last, say, 10 to 15 years average. And when one compares Indian market valuations to the peers in Asia, the valuation gap, the premium still remains quite high. It still remains higher than what it has been on an average over the long term. So, until and unless we see an overall improvement in investment sentiment across the Asian market, it would be difficult to take a call in the short term on India alone. Now, having said that, I think, in general, things are possibly likely to be a little better. Maybe not right now, but possibly in the fourth quarter of this year. The flow-related issues, the currency-related issues are something we have to watch out for.
Okay. Manishi, hi, good morning. So let's talk about some sectors, right? What tops the charts this morning is telecom. Bharti doing very well. Their India business has seen a sharp growth. ARPUs are going up. And now it's pretty much become a two-player market, you know, so one just knows that perhaps it's just upwards from here for these two. Would you put more money to work in names like, say, a Reliance or a Bharti, purely because of the growth in this space?
We are overweight Indian telecommunications. You know, we like the telecom service providers, and we are playing that through both the pure play options and the conglomerates, for exactly the reasons that you pointed out. From a sector that was plagued by competition, it has now become a virtual duopoly. And consequently, the kind of increases in tariffs that we have begun to see are likely to continue for the foreseeable time horizon. So yes, I think telecom is clearly one of the sectors to focus on, and we will keep our exposure to that sector for now at least.
IT services, Manishi, and the cheaper part of the IT services space. Any thoughts there? And when I say cheaper, I mean in the 15 to 25 PE band. Do you like anything? Go
on. As far as our Asian model portfolio is concerned, we are really looking at the frontline large IT service providers in India. And there's a simple reason behind it. We think these are the companies which are equipped to reinvent themselves, to change their basic DNA and adapt with the times. I mean, they have proven it time and again. These are the companies which are also, therefore, more adept at winning large orders from their Western Hemisphere customers. And these are the companies which are also adapting themselves to the post-COVID period, where there's a significant degree of cost savings that some of the companies have been able to eke out from the remote working tendencies. So we think that yes, there is a set of companies which are a lot cheaper, the mid cap and the small cap IT companies. But our focus on the Indian IT services still remains largely with the large frontline IT companies.
Manishi, what about automobiles? Because there's one view that this is the time to go for it, commodity consumers. But is it being too early here? Because there are supply side issues and there's demand side issue as well, right? So your thoughts?
Right. We do have exposure to automobiles in our Asian model portfolio, the Indian automobiles I'm talking about, and we are playing it entirely through the market leaders. So the market leaders in the segments like passenger cars or commercial vehicles, because the risks that you pointed out, that in terms of supply chain disruptions or the ability to pass on input costs to the customers, these are the companies which are equipped to do that. These are the companies which are equipped to tide over the short-term issues that we are facing. So here again, I mean, it calls for selectiveness. It calls for just a focus on the market leaders and therefore the companies which have pricing power. And that's basically our strategy in Indian stock selection.
I wanted your thoughts on what's been happening with, say, some of the new IPOs, right? LIC, for example, the listing was a bit tepid, but the future looks bright. What is your recommendation here, not just on LIC, but on that sector as a whole?
Right. Now, IPOs, obviously different IPOs come with the different, fundamentals, different management quality, and different market presence. I wouldn't comment on, specific IPOs or specific stocks, but, there's an index, I think an Indian IPO index, that has actually, gone down. It's been secularly going down for more than a year now. I think that has something to do broadly with foreign investors' sentiment on the market. If you look at FII selling in India, it commenced in October, and over the past 7 months or so, almost about 28 to 30 billion has been sold down. So, while some IPOs have possibly been overpriced, largely the reason for underperformance of these IPOs is the broader investor sentiment on the Indian market as a whole. I think one trend that might emerge going forward is a slightly better or more reasonable pricing of the IPOs, which would leave a little more on the table for the secondary market investors.
You know, by the way, I just want to point out, there's three-digit gains of the Nifty with 100, 101 points, but refiners, pure refiners, standalone ones, like MRPL and Chennai Petro, CPCL, both are up for the second day in a row, 9% on MRPL. Chennai Petro is up about 5%. So those are the ones which are doing well. And of course, I was mentioning Reliance, which has kind of come off the day's high. It's basically fallen below the opening level. So at about 25.36 on the May futures. What else? There is Minda Corp, which is up 5%. So things are starting to perk up a little bit. Galaxy Surfactants, we had the management with us just a while back. The stock's up about 6.5%. Indoco, we had the management with us. It's up 5%. So both reacting to earnings. And you just heard from both managements a while back. Tejas Networks is up about 5% or so. So just kind of highlighting stuff with volumes at this stage and not going beyond that. Lal Pathlabs, Anuj, we were talking about that earlier. It's down 5.5%. Metropolis is also down. So this is turning out to be a story which the market is paying attention to. I'm talking about the pricing pressure in the diagnostics testing space. So Metropolis and Lal Pathlabs down once again at this stage. So that's some follow-up there. Manishi, I don't know if you cover or your analysts cover any of these names here in the diagnostic space, but if you do, what do you make of them? The worry is that pricing will be driven lower because of a new competition.
I agree. So we have initiated coverage recently on the Indian healthcare sector, including some of the names that you talked about. Our preference still lies with the drug manufacturers which are focused on the domestic market. In a sense, the composition or the market focus or the drivers of the Indian healthcare pharmaceutical sector have changed. It used to be driven entirely by approvals obtained from the US FDA. Now it's more inward focused. Now it's more domestic focused. And some of these diagnostic companies, they basically fit exactly in that silo. It's basically the domestic market, especially in a post-COVID world, that that they increasingly cater to. That said, the entry barriers are relatively limited. So we do have concerns about margins being driven down, and therefore we don't have any exposure to those those companies in our Asian model portfolio right now.
Okay, the stock of the moment is Canfin Homes, by the way. That's surging at the high point of the morning. A lot has happened, of course, in this stock. Perhaps has a lot of shorts as well. So covering happening. Manishi, the whole theme. I'm not asking you about Canfin Homes, but real estate and the allied spaces. They have done well. Of course, in last correction, everything corrected. But do you have a positive view here?
We are still playing real estate through the mortgage lenders, and as with most other sectors, we are focusing only on the market leaders, basically the top rung players that, so, while real estate companies, the developers, their stock prices have appreciated. I mean, they have recovered significantly over the past 1 year or so. We haven't ventured into that area, partly because of the large leverage concerns. And we still think that, I think mortgage lenders are a better play, possibly a more de-risked play, on that sector. There are other plays like consumer discretionaries. There are some of the household goods manufacturers and sellers, which also fit into that bucket, which we are clearly positive on. So, fortunately, there's a lot of different ways of playing that sector. And, one doesn't necessarily have to focus only on the developers.
Okay, Manishi, we'll let you go on that note today. Thanks a lot for joining us. It's always good having that conversation with you. But let's move on then. The market, by the way,